Good day and welcome to the show. Today we're going to talk investment markets. We are currently living in a very, very volatile period. There is a lot of noise in the market. There is a lot of volatility going on, and I think in the lives of asset managers, it must be a crazy time. Now, First Avenue Investments recently launched its quarterly update for the fourth quarter of last year. And inside that report are very, very interesting insights. Shelo Gyose is with me. He is the Chief Investment Officer and the Principal at First Avenue Investments. Shelo, thank you so much for joining us.
Thank you very much.
It's a crazy time. Shelo, in your review, you use the term choke points a lot. I don't know if that is an investment term. I haven't heard it before in my life. What are choke points and what is the impact on investments?
Well, a choke point is an impediment that causes congestion that stops you from reaching your objective, generally. And it's usually used in military, if not naval, contexts. So the Panama Canal, for instance, is a choke point. It joins Pacific and the Atlantic Ocean. The Strait of Hormuz is a choke point, joins two seas, and ships have to cross that choke point. Now, usually canals are built to certain specifications to allow certain the sizes of ships to pass through, ships that have a certain depth and a certain weight, and so on and so forth, right? If a ship is not capable of going through that choke point, it cannot pass through with the goods that is ferrying in global sea trade. Similarly, stock markets navigate choke points, and choke points oftentimes come in the form of corrections, market crashes, where a portfolio has to navigate one environment, which is a bull market, into a bear market, has passed through that canal, right? And as it passes through the canal, if a portfolio doesn't spot requisite risk management, it often impairs the capital in the portfolio. You either suffer a large drawdown or you lose money completely. Some of the companies in the portfolio go bankrupt. That means that the markets have imposed a choke point on that fund, on your strategy, and your strategy has been found not to be seaworthy or worthy of passing through that canal. Now we live in a time where the choke point is not necessarily a bear market crash, but it's a correction in precious metals and in other basic materials, right? And if you had done well by owning those, and you own them without much thought to how much risk they might pose, when they correct, as they are correcting, and who knows whether it might end up being a bear market in them, the strategy that carries those precious metals in your portfolio might actually lead to your product, to your strategy actually being impaired, to your fund being impaired. And when it's impaired, it means it's non-commercial. You cannot sell it to anyone.
It's a very interesting concept. I can see the impact of commodity stocks on the local market, and it has been really, really positive. Yes. We've seen some volatility quite recently. But can you highlight maybe other choke points, maybe the Magnificent Seven across the Atlantic?
So if we could just go back maybe to 2018, 2019, right, when we had quantitative easing, right? And quantitative easing started off really slow. And it was really just a way for the Federal Reserve Bank of the United States, to try to lower interest rates, especially at the long end of the curve, so that Americans can reinvest in the economy and build wealth, right? And then COVID comes along, and COVID obviously completely freezes all economic activity. And then the Fed loads up an incredible stimulus package, right? Prints so much money that it actually encourages animal spirits, so much risk-taking, right? That you are actually paid not to be careful with where you spend money, right? What happened is resources, again, benefited from that. You may remember gold went berserk, but base materials went berserk. Bulk materials, everything in the resource space went nuts. financials also went nuts, but raw materials more so than anyone else, and precious metals more so than any other sector. If you were not holding those, your portfolio fell behind by such a large magnitude that to recover from that really would take you a good 5 to 6 years, right? In that 5 to 6 years, you are working on a recovery in which investors, your clients, are very concerned whether or not you'll ever recover their money back, right? So that was an incredible choke point. Now, when interest rates started to go down again, well, actually to go up again, right? If one had been positioned for that, then you start to recover your capital from quantitative easing. But, choke points come in various forms. They come in market crashes, they come in corrections, but they also come in global uncertainties, right? We can see now geopolitical global uncertainties, first caused by Ukraine, I believe in 2022, and now they're caused by a disruption in global world trade and global security arrangements, right? The United States is going it alone, forcing all other countries to also look at everything they do as a matter of sovereign importance, right? The beneficiary, gold. That's a choke point. If you don't own it, it really impairs your results. It really impairs your ability to create wealth for your clients.